Capital to talk about exactly that. Karan, great to have you in the studios. And first, let's talk about this LPG issue. While it seems like it's interim in nature and it seems that, there will be a resolution definitely in place. The government is working really hard. But should it get elongated? What's the damage that we're looking at?
Hi, Aisha. It's always a pleasure to be here. I think the LPG issue, we have done a deep dive in terms of the number of restaurants that are present in the ecosystem today. What is the kind of supply of LPG that they would require? What is the kind of impact they're going to have in terms of their usage? So just to break that down, we've got almost 4 million F&B outlets. Out of this, 15% is the organized outlets and the 85% is the unorganized outlets.
4 million
is all over India, basically,
over
right?
India.
So the unorganized part covers all your dhabas and the roadside food and so on and so forth. Now, within these 4 million outlets, 80% of the outlets are LPG dependent and 20% are dependent on electric and hybrid and all those kind of things. So I think from a demand perspective from the restaurants, there are certain category of restaurants, like for example, Jubilant Foodworks, they would probably need 20-25 cylinders on a monthly usage basis. For other companies, they would need about 5 to 10 cylinders per month. Then you go to standalone restaurants, they would need 3 to 4 cylinders per month, based on the cuisine and the category that they cater to. So those are used a lot of LPG, right, just for that perspective. So I think generally, on a thumb rule, of these 32 million outlets require 5 cylinders of 19 kg per month, right? So from this number, we clearly get that the demand for the cylinders for the F&B industry is about 1.7 crore, right? Now, if you look at the LPG supply situation, we have got almost about 7.5-8 crore cylinders today. Assuming that there's an increase in terms of the capacity and there's an increase in terms of the production and distribution, this number can go to 8.5 crores. As per the government latest notification, they have asked that 20% of this number will be available for the F&B industry, right? So we are largely there as far as F&B industry is concerned in terms of the demand that's needed and supply is largely there. But the government also made notification that this 20% number also includes weddings, parties, and corporate canteens, right? So if we include that number, the demand actually is closer to 2 odd crores on a per month basis for the cylinders, and the supply is almost about 1.6, 1.7 crores. So there's a shortfall of
massive deficit.
There's a deficit of 15-20% as of now. Another important variable is that today this number is 20% by the government. If situations does not kind of ease off and if there's a proper demand-supply mismatch, when the supply constraints continue from here on going ahead, we could see a scenario wherein this number can also come down. This 20% can come to maybe 15% or 10%. In that case, the demand-supply mismatch can increase further. So I think as of now, what we say is that very clearly, less than 5% of restaurants are shut today, as per NRAI. QSR chains are operating businesses as usual for them because most of them are dependent on electric and not on LPG for that matter. Some are trying to go hybrid, some are trying to rationalize menu, some are trying to reduce work hours in terms of the outlet opening. But QSRs are not seeing any kind of a big negative impact as such. I think the impact is more here for the unorganized players, the smaller standalone players, which use LPG and which can't go to electric in a short span of time. And assuming that 5% restaurants are shut down today, this will definitely have a negative impact on order volumes for Zomato Swiggy. And very clearly, food is 55 to 60% of their SOTP, and assuming a worst case scenario that 10 to 15% of restaurants eventually shut down in the next 1 month, you could see a 7 to 8% EBITDA downgrade for the food business for Zomato.
Oh, that's comprehensive and that's
and when
big.
you look at the numbers,
Yes.
you try and understand the gravity of the situation.
Yes. Karan, in your estimates that you're building in, are you building this? I know it's very difficult to quantify as to what you're building into your estimates, but if this were to prolong, would your target price come off in a material fashion?
So just to give you a perspective here, this 7 to 8% EBITDA downgrade is a quarterly EBITDA. Right. So if this situation prolongs for a month, let's say 15% of restaurants are shut down for 1 month, there's a 7% impact on quarterly EBITDA, which means annualized basis, this impact is around 2 odd %. And assuming that, the food business is 55% of SOTP, you generally tend to get a number of almost 1.5 to 2%. So as of now, this impact is very small. But two things can really turn in the negative manner. One is, of course, the number of restaurants shutting down. If the number of restaurants shutting down moves ahead from 15%, 25%, these numbers can swing miserably. And the second thing is also the time frame. So if the situation prolongs for 2 months, 3 months, these numbers could change massively in a negative manner for them. But as of now, the impact is quite subdued.
But tell me, let's look at it from the QSR angle right now, and not just the listed pool, but even beyond that, Karan. What is the option? I mean, it's not like undertaking price hikes is going to solve the situation, right?
I think for QSR perspective, they are the ones who are more dynamic in nature. So as I said, we may not see restaurants shutting down completely. So it's going to be a part and parcel. The first thing is rationalize the menu. Try and basically have menus which have got lower dependence on LPG. Second, of course, is the timings. There have been certain... So, I mean, this LPG issue also is not a pan-India issue as such. There have been certain states and cities where the issue is very, very large in terms of the supply being lesser and demand being higher. But in certain states, there are not a big issue as such. So it's very mixed bag as of now. So second option obviously would be reduce the number of workers that they have. And third, of course, most QSR companies are also trying to make sure that they somehow get electrical equipment inside the stores. So for example, in the case of fried chicken, they have got 60% dependence on electric equipment, 40% on LPG. So somewhere they're trying to increase the dependence on electric equipment going ahead. I think one more thing that can happen is that because the variety of options on a Zomato Swiggy will kind of see some bit of a negative impact, you could also see shift of consumption. So for someone who was ordering a dosa or a pav bhaji, which is maybe LPG dependent, could now opt for a burger if it's not available in that particular area or the restaurant that they would order from. So from that perspective, QSR also could see a positive bias in terms of order traffic.
And has pricing at all shifted? I'm curious now because if there is maybe a lack of, say, dosas or pav bhaji is available, has pricing shifted upwards?
I don't think so. There has been no change on pricing as of now. So I think if you look at the numbers as well, for the food tech aggregators, QSR is a very small fraction. As far as order volume is concerned, it's about 10 to 12%. As far as GOV, maybe 15-20% kind of a number. So 80% dependence is towards the other standalone restaurants. And generally, there are many standalone restaurants and cafes who also have a higher AOV as compared to the likes of QSR chains. So specifically from a pricing or AOV standpoint, there's not a big positive delta that we could see for the food tech companies.
And you're actually saying that QSRs may well benefit
in
this situation because you're saying burgers, pizzas with lower dependence on LPG.
All of McDonald's is electric.
Correct.
For instance.
Correct. So I think not pizza specifically because Domino's is 95% LPG led. So for the case of Domino's, that's higher. But for other pizza chains, it could be lower. But yes, in the case of McDonald's, it is 85% based on electric. Same with Burger King. And in the case of fried chicken, 60% electric based. So definitely fried chicken and burger are the two cuisines which will benefit because of this entire issue.
Other than the entire QSR story, I want to specifically talk about these food aggregators plus, a quick delivery as well, Karan. What is happening with Swiggy and Eternal with such a large Zepto IPO, much awaited one, which is impending? And it seems like, it's just a matter of time. We're going to hear the timing for Zepto as well. One, of course, is the faction of the market itself getting weak. But the way these stocks have got thrashed out, there's got to be something more to it.
So I think the worry is more on quick commerce. Obviously, there are worries on the food side, but as I mentioned, it does not translate to numbers in a big manner because assuming that 15% of restaurants shutting for 30 days is quite a negative assumption, which actually may not pan out if things don't escalate in a big manner from here on. So I think the bigger worry here is QCOM. I think QCOM valuations have come off sharply. 2-3 reasons for that. One, of course, there is some fear in terms of the management change, right? So this is what the investor feedback is, that there's been a management change with Albinder coming in and Deepinder going away. Potentially, there could be a strategic change in the QCOM business as well, which we don't believe
but
is the issue.
Albinder always helmed the QCOM business.
Exactly. Exactly.
So, I mean, there should be comfort, if nothing else.
Yeah, but this is a fear in the mind of the investors, which is obviously, kind of dragging the valuations to a large extent. A second fear, obviously, is competitive intensity. So, competitive intensity not only from the likes of Zepto, which are doing price wars, but also from e-com players. We are seeing the likes of Amazon and Flipkart enter this market. They are scaling up. They are scaling up in terms of the dark stores, in terms of the locations, in terms of assortment. But I think e-com getting into Q-com in a very big manner is something which may not happen as per our opinion, because very clearly both are very different propositions.
Yes.
I think e-com is just about a top-down approach, and Q-com is a bottom approach, wherein they want to understand the micro markets and the assortments very well. So I think e-com, Q-com will both coexist. I think e-com is not trying to kind of go for a price war the way Zepto is doing. They are trying to protect their own market share, because e-com is seeing decline in certain categories in certain markets. So we don't believe that e-com will actually scale up in a very big manner. Obviously, if e-com goes to a 25-30% market share in the Q-com business, it is a worrisome sign for Blinkit. But if Flipkart, Amazon, other e-com put together, they account for less than 10% of Q-com market share, I think there's enough for grabs for Blinkit, and they may not lose market share in a very big manner. So that way, I think Blinkit is quite safeguarded here as the Q-com business is concerned.
You spoke about Eternal, and you spelt out the numbers in terms of the EBITDA impact and the like. I believe Swiggy is better off, worse off? Do you have a view there?
So I think Swiggy, very clearly, last quarter onwards, they have started to move their focus towards profitability, and they are compromising on growth because they're not expanding as aggressively in terms of store count the way they had done earlier.
Yes.
So I think there will be a delta there if profitability is achieved. But very clearly, Q-com business is about scale, and they will end up losing market share to the likes of Blinkit and Zepto. And I think whatever valuation multiples we were giving to Swiggy were also for the growth rates and the scale that they had in terms of market share. So I think we upgraded Swiggy last quarter basically because the burn ratios are going to come down. The burn rates will come down significantly from a 1,000 crores EBITDA burn every quarter to more towards 500, 600 crores burn the next 2 to 3 quarters. And because of that, we upgraded the stock. But we clearly prefer Eternal here, primarily because they're market leaders. So we continue to have got 70-80% weightage on Eternal and maybe 25-30% weightage on Swiggy. But Swiggy is also not a bad bet, because you have to understand the fact that if the Q-com business is seeing a reversal in terms of price wars and losses behind us, you will see Swiggy also seeing a benefit out of it.
Karan, I also want to talk about the traditional retailers, right? Your Trends and DMarts, because what Q-com did was took the sheen away somewhat from these players. Do you think the valuations are lucrative enough right now when it comes to Trend or a DMart? And more importantly, as an investor, how do you approach this story now? I mean, is it just about store addition, or do you look at it purely from a bottom-up valuation perspective?
So I think on Trend and DMart, very clearly, as pointed out last time, we did have a preference on DMart versus a Trend. And if you look at the last 3 months' performance, that's how it's played out. I think what's worked in favor of DMart is, of course, one is this entire Q-com price wars behind us. Eventually, margins for DMart have come off in the last 4 to 6 quarters because of pressure from Q-com. And now we will see respite on margins. We may even see a potential positive bias on margin perspective. That's the first thing. Second, I think DMart from a store addition standpoint has kind of been better as compared to the likes of Zudio in terms of expectations. So they've added almost about 48-50 stores for the year. They'll potentially end at 60 odd stores for this year in FY26. So that is some cushion there. And LFL growth rates haven't converged. It's been in the range of 6 to 7, 6.5 odd percent. If the case of Trend, if you look at it very clearly, there has been a clear convergence of LFL growth. So I think the Zudio segment is actually struggling in a very big manner, and there's a decline on LFL there because of increased competitive intensity. So when will that reversal happen is a key moderable. Second, on store addition, I think there's been a disappointment. So our estimate for this year on store addition was about 150 odd stores. They have added only 120 stores until about 2 days back, and they may go to 150 stores. But Street is asking for a store addition of 190, 185 odd stores. So I think there could be a disappointment in the store addition. Third, I think, is the margin front, which has obviously been resilient so far. But if they were to compete with competitors, they may have to invest into quality for Zudio, and that could lead to margin disruption as well. So even though valuations for Trend are at sub 50 times PF 28, there is a risk of growth rates kind of becoming lower because of store additions not being up to the mark. And second is margin investments.
Would you then look for some of the value retailers where store addition as a percentage of the current store count is just far lower, and therefore new stores plus the SSSG is far stronger, plus the rural play?
Yes, absolutely. I think you have to see that most of these companies go through a cycle. So in the case of Zudio, I think the best is obviously over. Last 2 years, Zudio has seen some kind of pressure, but one may not really buy Trent aggressively unless we see a big reversal on growth rates, more towards 20% plus, because even currently we are all factoring growth rates of 20% plus on revenue growth fronts, and which potentially can have a disappointment if store additions don't come in the next 2 to 3 quarters. So very clearly, yes, there are players, maybe Vishal Megam or other value fashion players, which could see respite if they are seeing store growth combined with LFL growth, because Zudio LFL decline is quite sharp here.
Well, at least the movies are back. Finally, you know, that content dry, crib that all of us had, even as consumers. It just took that one movie to do it, right?
Yes,
Dhurandhar?
absolutely. I think last quarter was phenomenal in box office. Dhurandhar was extremely good. I think they released in the first week of December. They ended up doing box office collections of maybe 850, 870 crores net India. I think Dhurandhar 2 will be a very big surprise because Dhurandhar 1 actually picked up because of word of mouth.
Yeah.
So just to give you a perspective on numbers here, Dhurandhar 1, the day one opening was close to 30 odd crores, and Dhurandhar 2, the advances are already at 30 crores. So I think Dhurandhar 2 could open up to 90 crores to 100 crores. And I think it's a long movie, so you will see premiumization on ticket prices wherein consumers would opt for more recliners. Second thing to watch out here is that Dhurandhar 2, because it's established franchise right now, you could see this film being the highest grosser ever. So net box office record today is with Bahubali 2 of 1,000 crores.
Yes.
And if you look at the other films, like there's been Pushpa 2, there's been KGF 2, most of these films peak out on net box office at 850, 800 crores kind of a number. So Dhurandhar 2 could actually be the highest grossing film ever as far as net Hindi box office is concerned.
Wow, that's.
I'm sure you booked your tickets already.
Absolutely.
First day, first show.
Yes,
Wednesday, paid preview.
Yes.
Okay, we'll wait for the verdict then.
He didn't bat an eyelid.
Yes.
Because I saw the trailer and I was like, this is something which I have to see first day.
Yeah, and the music.
The songs, obviously.
Yeah.
Okay.
Yes.
Karan, thank you so much
Thanks
for
a lot.
joining us.
Thanks a lot.
Absolute pleasure as always. You've been very, very gracious with your time. So thanks for coming in.
Thanks a lot.
Viewers, we'll step into a very short break, and what we'll do is we'll continue coverage on the other side. So stay with us.